I'll make my own social media platform with blackjack and hookers. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of October 25th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Before we get started today, you are going to notice one really big change starting on this video. Different title style and a very clickbaity thumbnail. That's right, I have finally succumbed to the YouTube algorithm gods, and I'm looking to increase my CTR, my click-through rate on my channel, and one of the best ways to do that is with simpler titles and clickbait titles with stupid gaping mouth faces. Oh man, I hate myself so much for this one already. You guys know I had to do it. I really want to grow the channel so I can do this full time. The content itself is not changing. It's just the obnoxious clickbait thumbnails are there. Also, I did record my first option series video on Friday. I do have it edited. I will probably be posting that on Monday, and then every week thereafter, I'll be uploading it on Tuesdays. Last week, I got my second COVID vaccination, and it knocked me on my ample backside, and I kind of couldn't really do much for the rest of the week. Sorry about that. But, you know, overall in the market, it was quite positive for the week. There was a bit of a downturn on Friday. Some of the bigger companies got hit, but some of the mid caps were lifted up. Let's just get started with the news. This was, I think, the biggest news story of the week, and anytime former President Donald Trump is in the news, there is just an absolute circus about it. So Trump announces a social media platform launch plan through a SPAC merger. Former President Trump is launching his own social media network in order to stand up to the tyranny of big tech. The app appears to be the first project of the Trump Media and Technology Group, TMTG, so close to TMNT, Teenage Mutant Ninja Turtles, but it's not. TMTG will list on the NASDAQ through a merger with Digital World Acquisition Corp, DWAC. The transaction values TMTG at about $1.7 billion. Now, we'll get in some of the details here, but just in case you don't really know the backstory, President Trump was banned from Facebook and Twitter back in January after the whole Capitol thing. So he is just starting his own social media network, and it's going to be called the Truth Network. Okay. Well, no matter what you feel about this one, it sure is going to be a conversation starter. I find it funny because this is like actually a real life example of the freaking Bender meme. I'll make my own social media platform with blackjack and hookers. According to the press release, the Truth Social is currently available for pre-order on the Apple App Store, and a beta version will be available to invited guests starting in November 2021. A nationwide rollout is expected in the first quarter of 2022. What was truly remarkable about this is that DWAC and Phunware, which trades under the ticker PHUN, it's a digital advertising company that's been associated with Donald Trump before, surged to crypto-like valuations. And, you know, just seeing the percentage over 1,000%, 1,345%. It just doesn't, it's not as impactful as looking at the chart. Let's look at the chart. Here's DWAC first. DWAC is a SPAC. It was listed on September 30th, and it was trading just below NAV around 996, 997 until the 21st. And on that day, it opened up at 1273. This was just after the Trump announcement. It hit a high of freaking $52. The next day, it opened at 118.80, and it hit a high of 170. It halted, I don't even know how many times during the day on Friday, and eventually ended up coming back down to about 80.65 after hours. Regarding Phunware, Phunware was $1. It was a penny stock trading, what is this, about 90 cents. It started picking up a little volume when the Trump rumors started hitting, and then on the 21st, it ended up jumping up, closing at $1.53. This one went as high as $24. This is a 24x if you manage to time the top there. After hours, we're all the way back down to $6.63. Now, I'm not saying these are really good investments, but if you were in before they took off, you probably made a tidy profit, even after they've come crashing back down to earth. Phunware is still up 6x plus on where it was at the start of the week, and DWAC is still up 8x from where it was at the start of the week. These are massive gains, even if you didn't time the top. Now, I remember thinking on the start of trading on the 21st, after I saw the DWAC announcement, I was like, huh, I should probably buy that. Not because I'm a huge President Trump supporter, not because I think it's a good investment, but because I know that anything with the Donald Trump name on it is going to be a media circus. And I knew this was just going to be a giant meme, probably a pump and dump. And you know what? I'm saying this and I didn't do it. So I didn't have very high conviction and I'm kicking myself in the butt over this one, but whatever. So this is the part where you say, cool story, bro, because I didn't actually do it. One more quick note on this. This is from a Bloomberg article. Trump's tech SPAC could make him billions with meme stock frenzy. It's also unclear how Trump plans to build a social media platform on the scale of Twitter over just the next few months, let alone a streaming service, which is the next phase of Trump Media's plans, according to the press release announcing the company. That statement was light on numbers, even by SPAC standards. This is a direct quote from Kristen Marvin, the chief executive of research firm SPAC Insider. We have no financials. We have no business plan. We don't know how they got to the valuation, 1.7 billion. We have no information, and that's the fundamental problem. Representatives for Trump and Trump Media did not respond to the request for comment. Oh boy. This one sure does seem like a pump and dump, but it was actually retail pumping it, and Trump Media Group didn't actually fuel the fire at all. It was just an announcement. That's it. And when she's saying there's light on numbers, even by SPAC standards, yeah, there's nothing here. There's really nothing, and this is all completely speculative, and I hope nobody actually gets burned on this that watches my channel, but wow, what a ride if you were in. If you were in, please leave me a comment, let me know, because I want to see your gain porn. I really do. And this kind of just shows how, even though he's been out of office officially since January, Trump is still just like living in everybody's heads rent-free. This is absolutely hilarious from a business perspective, that he can just put his name on a poorly planned social media platform that seems honestly like it's going to be rushed to market through a SPAC merger, and SPACs have been dead. This is like the most successful SPAC of all time now. That's not an exaggeration. This is quite literally the most successful SPAC as far as opening week goes, as far as the increases after the merger announcement go, of all time, and it's not even close. So it's so funny that he could just slap his name on something and it turns into a circus and gets all of the attention. What's the phrase? There's no such thing as bad press. Here we go. Next news story. This one has to do with the Snapchat earnings, which I'm sure you heard they were a disaster, but they were so bad that actually they're going to be impacting Facebook earnings, Twitter earnings, everything that's coming this week. In fact, Facebook and Twitter started tanking last week after the Snap earnings. Snap stock plunged on Friday after the social networking firm posted disappointing revenue growth and guidance that fell shy of estimates on Thursday. The parent of Snapchat said its advertising revenue was hurt more than expected by Apple's change in the rules surrounding advertising on mobile apps. So their actual earnings weren't terrible, but they lowered their guidance significantly, and they're blaming this all on Apple. They're blaming it all on the Apple App Store changes. Here's the remark from the company. Our advertising was disrupted by changes to the iOS ad tracking that were broadly rolled out by Apple in June and July. Our advertising business was disrupted by changes to the iOS ad tracking that were broadly rolled out by Apple in June and July. While we anticipated some degree of business disruption, the new Apple-provided measurement solution did not scale as we expected, making it more difficult for our advertising partners to measure and manage their ad campaigns for iOS. They added that the Apple changes have upended many of the industry norms and advertiser behaviors that were built on the IDFA, Apple's unique device identifier for advertising over the past decade, which now requires a double opt-in by users in order to access directly. You know, I can't even like cry for Snapchat here. I can't even be sad for these advertisers. Apple made this policy change back in June, July, and they really restricted the amount of tracking that these companies are allowed to do through their apps, since the users have to double opt-in. And let's be realistic, most people don't want a single opt-in. Who's going to double opt-in? It's just not going to happen. So they really got their targeted ad revenues killed, just massacred. And Snapchat just happened to be the first one to report, but they ended up wiping out their gains for like the entire year. And we'll take a look at the chart in a second. But first, I want to look at one more article about this. So Apple has upended the online ad market. Snap is just the beginning of the pain. Apple's push to protect consumer privacy by limited targeting advertising on mobile devices, announced more than a year ago, is finally hitting home for both ad-reliant online businesses and the companies that use those ads to drive sales. Advertisers that rely on mobile are scrambling for alternative ways to reach consumers, and online businesses are feeling the effects where they hurt the most on the the bottom line. How widespread the damage will be should become clearer next week when Facebook, Twitter, and Alphabet all report their September quarterly results. Here's the big one. Data from the mobile app research firm Flurry indicates that only 15% of US consumers opt into tracking when offered the choice. No surprise, given that the only advantage for consumers is that the ads they see are more targeted. In August, Flurry noted that at least 80% of iOS devices had been updated to versions of the software with the new, tougher ad standard. That from Flurry is based on a study that was only accounting for single opt-in, not double opt-in, and still, they showed that only 15% of the users were doing single opt-in. With Apple's double opt-in, that number's gonna go down, I promise it. And we're looking probably at something below 10% of the targeted advertising for all devices using the iOS. That is a huge loss for these companies on their revenue through targeted advertising, but I don't feel bad for them in the slightest. You know, you could tell they were blaming Apple. They said basically outright that they're blaming Apple. Snap mentioned that most companies had spent 10 plus years developing the targeted advertising for the Apple ecosystem, but I mean, come on, Apple gave you guys a year warning. It rolled out in June, July, and still, you can't blame it after all that much time, really. But I also don't want to paint out Apple as the good guy here, because Apple is going to be benefiting from this greatly, as they're still going to be able to do some targeting advertising on their own devices with different opt-ins. So Apple is going to be monetarily benefiting from this, and this looks even more bullish for Apple going forward into the future. Take a quick look at Snapchat's chart. You can see just this devastating drop after their earnings. The day before earnings, they closed at 75.11. They opened the next day at 58.75, closed at 55, resulting in a 26.6% loss throughout the day. And this is a really fun mirror to after their last earnings report, where they ended up gaining 24%. Well, they lost that and then some. In fact, we actually have to go all the way back to May for prices this low in Snap. Next up, just a quick mention of the Evergrande situation. I thought this was terrifying. What lies beneath hidden debt fears feed China's property woes? I saw this headline and it's on Reuters, and I was confused because everybody's really only talking about Evergrande and then the contagion situation. Numbers don't lie, you just need to be looking at the right ones. That's the problem for investors searching for the next trouble spot in the Chinese real estate sector. The figures on the book sometimes don't tell the full story. Since Beijing started clamping down on corporate debt in 2017, many real estate developers have turned to off-balance sheet vehicles to borrow money and skirt regulatory scrutiny. Analysts and lawyers say, holy shit. So not only does China disallow third-party auditing, but now their own companies are using off-book measures, off-book accounts to freaking borrow money. What? How can this situation get any worse? Oh my gosh. Joint ventures are a popular choice because unless a company holds a controlling interest in one, it can keep the details of it and the debt it acquires off its balance sheet. Nearly every developer has borrowings in disguise. The sector's debt problem is worse than you see. Chinese developers owed 33.5 trillion yuan, which is about $5.24 trillion through various channels at the end of June, Nomura Capital estimates, based on the official statistics, adding there are definitely other obscure financing channels yet to be discovered. Oh, okay, so they owe 5.24 trillion and it can be worse. This is frightening. I don't know how else to spin this. I'm not like a big doom and gloom kind of guy, but this is ridiculous. I've been talking on this channel since my channel's inception that I don't like China because of the lack of third-party auditing, the lack of financial transparency, and this makes it even worse, knowing that the majority of real estate developers in China are using off-book accounting methods to borrow money. There's nothing positive that can be said here. This doesn't end well. Next news story, and this is a big one. The SEC's GameStop report questions game-like trading apps. That's possibly the worst headline and the worst way to summarize the article out of Wall Street Journal here. But, you know, media be media. Agency report finds buying by hundreds of thousands of investors fueled the January meme stock rally, and and dismisses alternative theories. That's interesting. So I've actually taken some flack on this channel, and I don't care about it because I'm still a believer that GameStop has not squeezed yet. And this SEC report actually tells us that GameStop has not squeezed. Now, they don't say yet, they're not saying something is pending, but they said that the price movement was retail driven and it was not driven by firms covering their short positions. So when I read this report, I felt slightly less crazy and I was able to take my tinfoil hat off because, hey, here's a reputable regulatory body saying the same thing that I've been saying. There hasn't been a squeeze yet. And they're actually saying there wasn't even a gamma squeeze. This was all just retail fervor. The agency poured cold water on a number of alternative hypotheses for why the struggling video game retailer's share price soared from less than $20 at the end of 2020 to an intraday high of $4.83 on January 28th. And then they mentioned trading apps. Wow, thanks guys. Yeah, we're all playing a game with our money here. That's what's going on. In the wake of an anomalous market event, it could be tempting to identify a convenient scapegoat and leverage the event to pursue regulatory actions without regard to the factual record. The report, however, finds no causal connection between the meme stock volatility and conflicts of interest, payment for order flow, off-exchange trading, wholesale market making, or any other market practice that's drawn recent popular attention. More reporting of short sales, a method of betting a stock's price will decline, could help regulators and monitor markets. I agree with that. And here's the big ones. Purchases of the company's shares by investors seeking to cover the short positions was a small fraction of the overall buy volume, said the SEC, suggesting that a so-called short squeeze wasn't the main impetus for the rally. It was the positive sentiment, not the buying to cover, that sustained the weeks-long price appreciation of the GameStop stock. The SEC also found little evidence that a similar phenomenon associated with options trading known as a gamma squeeze was to blame. That's kind of it. They aren't really doing anything about this. They said we need some more reporting on short interest, which, yeah, I agree with that, but also they're not going to be over-regulating anything on the retail side, but they're also not going to be more heavily regulating anything on the fund side either, so I guess nothing happened here. Really, the best knowledge coming out of this was that the SEC feels that there was not a short squeeze, there was not even a gamma squeeze, and that all of this was simply retail driven. And why is that a good thing, you might ask? And I would say because that means retail itself was able to move the price of the stock from $20 up to $4.83. That means that there's really not as many shares out there as we think because retail simply doesn't have that much buying power. So I'm thinking that there are fewer shares available to trade than everybody's willing to admit right now, and something is still going to happen here. That's all I'm going to say about that one. I still have my GameStop position. Let's move on. This is cool because, you know, I live in Korea for the millionth time. Netflix's Squid Game will generate about $900 million. This is crazy. Netflix ended up just reporting this. Bloomberg is quoting internal Netflix documents that stated Squid Game, which is their new hit on Netflix. It's a Korean drama about a survivor game. It cost $21.4 million to produce, which is around $2.4 million an episode. More than 130 million people have watched the Korean show, and it's considered Netflix's most watched original show. People have spent more than 1.4 billion hours watching the show. That's absolutely nuts. But this, I mean, just look at it this way, right? Netflix spent $21.4 million to produce this show, and they're going to be generating $900 million in value for the company. Now, how they determine this value is an internal metric, and they've been doing this for a long time, so I'm trusting that that metric is accurate, but it's going to be based on subscription renewals, new subscriptions, and just kind of free advertising when people are talking about it. So pulling people into the platform, increasing view time, it's all included in that value metric. But just look at that ridiculous gain there, from 20 million-ish to create the show up to 900 million in return. I have said some kind of disparaging things about Netflix, how the quality is going down, but this really goes to show you that as long as they can still pull off a hit, like literally one hit, this can carry them for an entire quarter plus. Now Netflix is sourcing international content with more regularity, and they've even stated that they want to look into the more international market to help grow their content base. And this is exciting. And I mean, Squid Game is a huge deal here in Korea. Everybody's super proud of it, becoming so popular popular in an international audience. Maybe eventually I should get around to watching it. But you know, I was looking at it and I was looking at the pictures, and I haven't seen an episode. But what's with the PlayStation guys? Like, what's all the masks with the PlayStation controller buttons? Are they like evil? I don't know. I should probably watch it. Netflix ended up having a big rise after earnings, after that announcement was made about the popularity of Squid Game. We had 2 consecutive days. We had a 4.48%, so a 4.5, and then about a 1.75. So over the 2 days, we're looking at above a 6% gain on the share price for a stock that's got a float of 400 plus million and $660 share price. This is phenomenal growth for the company. And really, since their last earnings report, when I was kind of negging on the company, they've been doing astoundingly well. I mean, the share price has gone up another 30% since that earnings report. Next news story, Zillow slams the brakes on home buying as it struggles to manage its backlog of inventory. Zillow will stop buying homes through Zillow offers for the rest of the year as the company's iBuying program goes from full speed to full stop. The company announced on Monday it would not contract to buy any more homes in 2021 in order to work through the backlog of homes it already has bought. I just kind of wanted to facepalm when I was reading this article, mostly because I think I just talked about this a couple weeks ago where Zillow was paying like a 30% premium on some homes to acquire them and build up their inventory. And just a couple of months later, maybe even a couple of weeks later, they stopped because they can't manage their backlog. This seems like an incredibly irresponsible misappropriation of funds. How could they have failed to gauge the market interest for those homes that they were scooping up at premium, and now they have to stop the program entirely because they have a backlog? I feel like this is going to have a negative financial impact on the company for at least a quarter or two. And I haven't seen the numbers for it. And honestly, I'm not financially savvy enough to really understand them right off the bat if I did see them. But my gut is telling me that this is not a positive sign. Quick look at the Zillow chart. It has been in a downtrend since the beginning of February when a lot of the tech stocks were rising. We've actually given up all of the gains for the last year already with Zillow. But this news this week didn't really impact it terribly. There was a big red candle on Monday from other market-related events, but it did just slowly rise throughout the week. So I'm not really sure why nobody else thinks this is as bad as it is, but I feel like this is a severe misappropriation of funds. Next news story, Cathie Wood explains why ARK dumped China stocks. Now, I'm not going to be one here who's just going to S Cathie's D and tell you guys that she's the greatest investor of all, but fact is ARK carries a lot of weight anytime they do something. It's all over social media, and it is worth looking into, and I actually really like the reason that they chose to dump their Chinese stocks. Despite Wood increasing exposure to some Chinese tech names, including JD, NIO, and Pinduoduo, she said ARK is starting to pull back from the majority of its Chinese exposure when regulators stifled Jack Ma's Ant Financial Group IPO in November 2020, so this is something that they've been unloading for a little while now. We had got into China because we saw their reaction to COVID. It was the most disciplined country in the terms of monetary and fiscal policy during the crisis, and I thought China had the possibility of becoming the Germany and Switzerland of the world. I don't know where she got that. But almost every week and every month, China was announcing a regulatory crackdown. We do own some China and a few of our portfolios focused on autonomous technology and robotics, but we're very particular. They have to be a low margin company because margin is clearly not appreciated by the government anymore. They want common prosperity. That is actually an astounding take on this. If you look at the crackdown for what the government has been doing with companies like Tencent and Baba, where they're demanding money, basically higher taxes from those companies to go for the common good. If a company is already operating at low margin, then they can simply show the government their sheets and say, well, do you want us to fail or do you want us to slowly grow? In most cases, I would think the government would look elsewhere for funding, even the government of China. This is actually quite brilliant. If you're looking at investing in a Chinese company, take a look at the margin. And if it's operating at a slim margin and still growing, then perhaps that is a very financially healthy company. And that's a company that's worth investing in, at least while we're in the season of all these regulatory crackdowns in China. This is some 4D chess right here out of Cathie Wood, and I like this approach to looking at the Chinese companies. Next news story, Cleveland Cliffs earnings top and they see higher steel prices. The Cleveland Cliffs earnings report was fantastic. They reported a Q3 EPS of $2.33 versus just 4 cents a year ago. So year on year, 4 cents to $2.33. Yeah, a couple 100%. Revenue also topped expectations, surging 260 165% from a year ago. We went from $2 billion annual revenue in 2019 to expected revenues of $21 billion in 2021. That's a 10x increase. CEO Lorenzo Gonçalves said in the earnings release. He also added that Q3's $1.9 billion of adjusted EBITDA equals 50% of the $3.8 billion year-to-date total, showing that our profitability continues to increase. This is a huge one, and this alone could have accounted for the massive gap up that Cliff had. Using its record free cash flow, Cleveland Cliffs retired $1.2 billion in preferred stock in Q3, equivalent to buying back 10% of its shares. Gonçalves also touted Cleveland Cliffs' successful negotiations of annual fixed price sales contracts with some of its most important customers. Differently from other steel companies more exposed to spot prices, we believe that our average sale price next year should be higher than in 2021, allowing us to continue to grow our already strong profitability and to further strengthen our balance sheet. This was yet another fantastic earnings report from Cleveland Cliffs. This is the company that I'm more bullish on than any other right now, and it's been that way for a couple of months, and here's yet another reason why. The company's insanely profitable. They ended up retiring preferred shares equivalent to about 10% of the stock. That's nutty. I don't think anybody was expecting that. But the big deal is, if you look at the futures prices for steel, the futures prices are declining going into 2022, and especially with the Chinese situation, the real estate situation happening where development is going to be slowing, they're going to be importing less steel, the prices are going down. But because of the way Cleveland Cliffs intelligently structured their contracts long term, they're actually going to be doing better next year with lower average steel prices than they have been this year with record steel prices. And this year was already a record. How can you not look at this company as an insane opportunity? I really think that Cleveland Cliffs is one of the best opportunities in investing right now as far as safe returns goes. If we take a look at the chart for Cleveland Cliffs, you can tell when they released their earnings report, we have a giant green dildo candle here, 12.7% increase on the day. We opened 22, we hit a high of 24.10, after hours 23.90. It's sustaining. This is phenomenal for this company, and it really looks like they're going to be taking the next step forward. Last week I reported on the average and the median net worth for individuals, and here's just a little follow-up. The wealthiest 10% of Americans own a record 89% of all US stocks. The top 1% gained over 6.5 trillion in corporate equities and mutual fund wealth during the pandemic, and the bottom 90% of Americans held about 11% of stocks and added 1.2 trillion in wealth. So the top 1% gained over 6.5 trillion in wealth, and the bottom 90% added 1.2 trillion in wealth. Can anybody say income disparity? This is ridiculous. This is much worse than I thought. But, you know, I want to just take a moment. Last week, if you were discouraged by the net worth figures for the average, the median based on age group that I shared on my channel, if you're watching this channel and if you own any stocks, I want you to take a minute and give yourself a round of applause. Seriously, you're putting yourself in position to have a better future. This whole 1%, 99%, I realize there's a massive gap between them. There's a huge income disparity. But you know what? You're doing the best you can to make your situation better for you and your family and your future. And I applaud all of you for that. I applaud myself for that, damn it. Let's take a look at the upcoming earnings for this week. This is going to be a really interesting week, and I think there's going to be a lot of negative movement with these companies. So keep in mind, we just had the news about Snapchat. I think this is going to negatively affect the forward guidance for Facebook, for Alphabet, for Twitter moving forward. I really think they're going to be negatively impacted by that. I think that Shopify and Amazon and eBay are going to be reporting some pretty good numbers heading into the holiday season with people that got their shopping done early. I think that all of the banks, the smaller banks down here that haven't reported yet, following the trend of the larger banks, they're going to be fine. Visa and MasterCard, it's always great to see their earnings because they're kind of the bridge between old style financial institutions and fintech. You have Visa and MasterCard, they're just ubiquitous global brands, and it's always good to see how their payments are being processed globally. We've got RBI and McDonald's. RBI is Popeyes, Burger King, and Tim Hortons in Canada. A lot of energy companies coming in on Friday. Friday with ExxonMobil, Chevron, Phillips 66. Also, after the bad Corsair announcement last week, I actually expect Logitech to tank on Monday. After its earnings report, regardless of what happens, I fully expect Logitech to tank, and I'll go into that in a moment. But also, it's probably going to be affecting Texas Instruments, Western Digital, MicroStrategy as well. It really has to do with the supply chain shortages cutting into the revenue. Mattel killed their earnings, so I'm assuming Hasbro is going to be going up pretty hard. Lockheed, Raytheon, and Boeing, the defense companies, are going to be reporting, but we haven't had any new wars lately, so I don't expect much excitement there. Ooh, that's dark. When I first looked at this company, I swear it was called Anally, but I guess it's Anali. Okay. And this is also the first time that I've noticed the Colgate-Palmolive logo is actually a CP. I always thought it was just a blue logo, but it actually says CP, a little cheese pizza, a little FBI open up. So here's what I'm talking about with Logitech going down this week. Corsair issues preliminary Q3 results and they trimmed their guidance. This was pretty bad. Global logistics and supply chain related issues have affected the company's 2021 net revenues by at least 10%. This is preliminary guidance and they're already saying at least 10%. Usually companies like way undershoot their preliminary information, especially if it's negative. The company also updated the 2021 annual net revenue guidance to 1.8 to 1.9 billion. That's down from 1.9 to 2.1. Now, they're reporting a range here, and if you go min-max from 1.8 to 2.1, this is a 10+% decline in net revenue. So no matter what, Corsair is going to be pulling back by about 10% here on net revenue for the year, for the quarter. This looks really grim, and they're saying a lot of this is just due to supply chain bottlenecks, which is going to affect every single tech company to a certain degree. So I'm not saying everybody's going to be affected 10%, but there should be substantial downsides for Logitech this week, for MicroStrategy, for all of the tech companies that are reporting. Does that mean I'm going to buy puts on them? Absolutely not. I'm focused on my selling options series right now. I'm not buying any options, but that is something that I'm going to be kind of filing away in my brain cave to see if I'm right about it next week. One more note that I wanted to make. We have Starbucks reporting on Thursday, and I am not a Starbucks investor. I actually hate their coffee. I think it's all burnt and it just tastes like crap and it's overpriced. But similar to my anecdotal observation about Costco, I think Starbucks is just a phenomenal company to invest in. There's also kind of a meme about Korea being like the coffee shop capital of the world, and Starbucks is everywhere in Korea. I don't even know. There's got to be like 5,000 plus locations, and that's probably not an exaggeration. But people just give Starbucks gift cards for like birthdays to say thank you. They send them automatically on Kakao, which is the big chat app here. And I got one of those gift cards and I went to a Starbucks to use it, even though I hate Starbucks. And I know you can't read Korean, so I'm going to help you out here. This one right here, it says Starbucks. All right, so here's our Starbucks. And I was sitting in here and I was right by the front window drinking my Oatly oat milk latte, my overpriced gift certificate latte, and I was looking across the street. Follow my line of vision. What is this right across the street? Starbucks. I was looking at another Starbucks across the street from the Starbucks that I was in. And it gets even worse. If you zoom out and just go down the road a little bit, look at this. It's another Starbucks. That's not an investment thesis. That's not investment advice. It's just an observation that Starbucks is crazy popular here in Korea, and I want to, just out of curiosity, see what their international sales figures are on their earnings report. All right, that's it for me today, everybody. I hope you did enjoy the video. Like I said, I'll be posting the first video in my options trading series on Monday. Also, I have 2 more videos recorded already that I just have to edit, explaining how to manage your days to expiration and explaining how to screen for stocks for the wheel. So you are going to be getting another 2 or 3 videos from me this week. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Webull's a fantastic trading app with tons of resources. And if you enjoyed the content today, please like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.